So I mean, this is a very complicated decade in terms of macro and valuations and capital flows, raising rates and tightening monetary policy into a declining PMI environment, Purchasing Managers Index environment, and that seems to be what we're entering. And so if they end up having to kind of not tighten policy as much as people expect, you can get kind of a pretty sharp downward move of the dollar. I am somewhat bearish on the dollar versus some of the other major currencies, but I think that's kind of a race among losers. Like I think, it's the bigger thesis is that real assets should do better, should do well in fiat currency terms, I think, over the course of this decade. So that'd be the commodity area. Real estate's interesting because if you look at most markets, a lot of them have really expensive real estate markets, like say China, Australia, Canada, parts of Europe, very expensive real estate markets and not very expensive equity markets in some cases, whereas the United States is the opposite. Our real estate market, there's some areas that are very hot, other areas are somewhat appropriately priced compared to international markets, so at least on a relative basis, and whereas our equity markets are extremely expensive. So I think the combination of certain areas of real estate could do well, or at least well enough on, compared to other alternatives. And I also think that commodities and real assets are pretty well positioned. And then exactly which ones depends on where the demand is. So I think industrial commodities are going to do well. I think energy is going to do well. I think, gold is probably going to do well. There's some, central banks still hold a lot of gold. Some of the retail industry has gone into Bitcoin. There are funds out there like Incrementum that say have gold and Bitcoin together in a fund. They're kind of these alternative monies that people can get into. So I think that having a broad outlook on all these different assets is probably at least the way I'm playing it. Emerging markets have a lot of dollar-denominated debt, and so when the dollar is strengthening, either due to some combination of kind of just policies or capital flows, people assume interest rates are everything, but they're not. I mean, they're a key factor, but it's also capital flows. But basically, when the dollar is strengthening relative to their currencies, it's kind of like they're quantitative tightening, but they don't want to be doing it, and it's usually during a recession. So imagine quantitative tightening at the worst possible time, and so that's why emerging markets in large part are volatile, and so they also, I mean, they are, now the majority of GDP, the majority of population, and the majority of commodity consumption worldwide. And so when they're being squeezed by a strong dollar, it generally puts them into recession or at least a slowdown. And so it hurts their commodity consumption. And so when you have a weaker dollar, it feeds on itself because in addition to commodities being priced in dollars, it gives some breathing room to emerging markets. It allows them to ease and stabilize more, and you can increase their commodity demand. And some of them have kind of, China is more tech focused, so it's not even really kind of the same thing as an emerging market anymore. But for example, Brazil is kind of a classic emerging market. And if you look at its GDP price in dollars over time, it had this big decline in the late 90s and early 2000s, and then it had another big decline ever since 2014 or so. And these were associated with strong dollar environments and weak commodity environments. And so if you get a reversal in that, if you get capital flows coming out of the US and into either emerging markets or into just other developed markets, at the same time as you have commodity scarcity, you can have a pretty explosive emerging markets move. So something I'm looking for. I think we're still kind of early signs. But for example, as the world kind of goes into a post-pandemic environment, and as you have some of this, I think there's a good chance of rotation, but it's still early days. I used to hold Apple stock when it got, in my view, overvalued. I sold it and it went up further. Whereas other ones, like say Microsoft, I kept holding for a longer period of time. I only sold that very, very recently when it started to show kind of price weakness right around what was the top. I mean, maybe looking back 2 years from now in this interview, maybe it wasn't a top, but for example, I did trim that one out. Other times I hold things a little bit too long. So for example, in August 2020, my newsletter, I talked about how I see basically gold being temporarily overdone, even though still being long-term bullish, because I saw basically real rates, at least measured by the TIPS market, were bottoming. And also at that point, I was doing some fundamental analysis on the supply-demand characteristics of Bitcoin. I was expecting a pretty big run, which Bitcoin was pretty cheap back then in mid-2020. And so I was kind of shifting that bullish into bullishness into Bitcoin. Now, I didn't sell the gold and gold miners, and I probably should have because they went on to stagnate for a period of time. And so it's one of those things. Sometimes I identify things but don't really take action on it because I have that longer term preference. And then some of the moves last longer than I expect, or say I have a bigger price move than I expect, and I end up wishing that I had taken action. And so but in general, what I do is I look for a combination of some sort of fundamental catalyst, overall valuations. So I don't want to own things that I think are fundamentally mispriced, even if I expect them to keep going higher. I start to get nervous at that point. So I want to own things that I think are fundamentally appropriately priced. But then, when they get overvalued and maybe start kind of losing momentum is ideally when I want to shift into other assets. So generally with equities, I have a long-term focus because if I own a high quality company, I'm willing to own it through periods of being maybe mildly overvalued or undervalued because I want to have this kind of tax efficient long-term compounding approach. Whereas commodities can be more boom bust. So I'm a little bit kind of quicker on the trigger finger in terms of maybe getting out of things that are overdone and getting back in. So it really kind of depends on the asset in question. But overall, I like to have a multi-year holding period for most of my holdings. So I mean, this is a very complicated decade in terms of macro and valuations and capital flows, and a lot of things that people, it's I think there's that Mark Twain quote where it goes like, it's not what you don't know that gets you, it's what you think you know that just ain't so. And so, for example, people are assured that, say, if the Fed tightens, that means the dollar is going to strengthen. But it really depends on what capital flows do, right? So it's not just relative interest rates, it's also capital flows. And so one kind of catalyst I may be watching for is that the market has priced in so many rate hikes over the next 2 years, but they generally have historically had a tough time raising rates and tightening monetary policy into a declining PMI environment, Purchasing Managers Index environment, and that seems to be what we're entering. And so if they end up having to kind of not tighten policy as much as people expect, you can get kind of a pretty sharp downward move of the dollar. But if they follow through with those hikes, I think you could get kind of a stronger, kind of at least a stable or stronger dollar period than people expect. And some of these trades might take a little while to work out. And so I think that I'm still kind of managing time frames in terms of having a very long-term, kind of inflationary pro-commodity outlook for the decade, while being kind of somewhat cautious around the margins here in 2022 and going into 2023, because you have kind of fiscal gridlock, as you mentioned before, kind of some of this bank lending kicked in. So I'm still kind of bullish on the home building area in general, but I think we could see a lull here, and we've already seen some damaging price action for some assets. I think that's going to be probably still choppy for the rest of the year until I see some sort of catalyst to maybe suggest otherwise. But everything's kind of probability focused in this business, rather than so many analysts or so many people are kind of sure of everything, and I think that's where you really run into trouble.